Over the last few days, I've had bucket loads of UK-based budget updates. It seems that every professional services firm is in a race to provide a budget update as soon as they can directly after the budget. All of them, or most of them anyway, are factually correct and professionally produced. But there's a problem. They all show what's changed, but rarely talk about what you should be doing about it. So in this video, which is a lot later than most of the budget updates that you'd get, I want to talk about the changes that have happened in the recent budget, but also provide some practical, actionable steps you need to consider when thinking about your own financial plan related to the budget. Welcome to What Happens Next. On the 26th of November 2025, last week as I record this video, Rachel Reeves stood up in Parliament and delivered the UK's 2025 budget. Now, as I record this, there's still plenty in the news about the budget, but not much of it actually practical and actionable. So in this video, I want to look at the things you need to be aware of, both in this year's and last year's budget, and how to think about how it applies to your own personal financial plan. Now, whilst the budget contained a lot of specific changes, I want to share 6 tips highlighting specific changes in this year's budget and the action you should consider taking to your own personal financial plan based on what was announced. I reckon at least one or perhaps 2 of my tips are going to surprise you. So let's move on to number 1, ignoring the noise. Here's the interesting thing. As I record this, there's loads of news, loads of noise online, and loads of speculation about the way the budget's been communicated, and in particular, the difference between the slightly more optimistic illustration from the Office of Budget Responsibility and how that differed from what the Chancellor Rachel Reeves said. And I get it. The idea of the news media is to get your attention, find a story that's going to get your attention, and fill the pages of their particular websites and newspapers. The media business model, we all know, is based on attention. And talking about politicians lying about what they said is one short way of getting attention. But here's the thing, it's really unlikely that any of what you read in the news at the moment about the 2025 budget, particularly around the difference between one opinion and another, is likely to make a difference to your own personal financial plan. Regardless of your own particular political leanings, this point is really important. Often we get caught up in the noise, but often the most healthy thing to do for your financial plan and your own well-being is to look at the budget changes practically. If you're working with a financial planner, revisit your cash flow. If you're not, a great question to ask is, how are these budget changes likely to impact me in 10 years' time? And then get really clear on that answer. That might mean you want to start working with a financial planner, but a good starting point, if you don't want to do that, is to have a spreadsheet that maps out your financial future 10 years in advance. Either way, my experience tells me that often the noise is a distraction, and getting really clear on what your medium to longer term financial plan is doing allows you to stay calmer through the noise and take practical action designed to improve your plan. Let's move on to point 2, the impact of higher dividend tax and frozen thresholds and what you should consider doing about it. From April 2026, the government is increasing the tax rate on dividends and increasing the tax on property income from 2027. So for dividends, if you're a basic rate taxpayer, your dividend tax rate will be going up to 10.75%. And if you're a higher rate taxpayer, that jumps to 35.75% on dividends. This might matter to you practically if you're planning to live off your investment income and draw down on that, or take dividends as part of your income mix. You currently or intend to receive income from rental property, or you've got significant savings that are now earning more interest than they did a few years ago. Because even though they've deferred it for an additional year, one of the things they have included kicking in as of 2027 is that there's going to be slightly more tax on the interest you receive from your savings. So, if more of your future income is coming from investments held outside tax shelters, the budget has made that a little bit more expensive. Also, the Chancellor has decided to continue to freeze additional tax and national insurance thresholds. This means that either your earned or pension income increases, more of it will fall into the remit of tax. But before I talk about the practical action you should take, because of frozen thresholds and because of the increase in the dividends, property income and interest income rates, I want to share with you a free gift that we give away on What Happens Next. Because we've got a quiz that allows you to think about the next chapter in your life, particularly pertinent when you're in your mid-50s to mid-60s, and what you can do about it. You can find this at www.whathappensnext.life/quiz. There'll be a link in the notes, and if you click this QR code, you'll be able to find it. But what it typically gives to people who take the quiz is clarity not only where they are from a financial well-being perspective, but the other elements we know have a positive impact when you're in your 50s and 60s and thinking about your next chapter. Feel free, as a gift from us, to take the quiz, and I'd love to know what the outcome is across all areas of well-being once you've done it. Coming back to the freezing of the personal allowance though, it always feels like a bit of a stealth tax to me. One that's used by both blue and red governments in recent years in the UK, but effectively means that you pay more tax because more of your money goes into the thresholds where tax is payable, but they don't raise the rates. One slight quirk the Chancellor has confirmed is the fact that it's likely that state pension income over the next couple of years is going to be slightly higher than the personal allowance. But if that individual only has their state pension as income, actually income tax won't be charged. But for the majority of us, where the likelihood is we've got income from a bunch of different sources, including in retirement, you're going to find yourself paying more tax. So, thinking about the practical actions, I reckon there's three. Firstly, I'd be looking, particularly if you're a business owner, increases in dividend rates mean that a conversation with your accountant about how you pay yourself and the right balance and mixture of contributions from both salary and dividends might be really useful. Don't forget that also there's some really tax efficient work you can do to make pension contributions if that's right for you. Secondly, I'd look at, if you're married, to see how you use both you and your partner's allowances tax efficiently. Often when I'm working with clients, they're not always set up as tax efficiently as they could be, because one individual in the partnership might be using more allowances, one might be using yet less, one might be paying a load more tax because they're in a higher bracket, one might be in a lower tax band, and often they don't align their plans to looking at how efficiently to manage their money tax-wise moving forward. Now, there's a really good news thing here, because if you hold wealth, if you've built assets, one of the often concerns is actually transferring that asset to somebody else triggers capital gains tax. The good news is that the transfer of assets between spouses, usually 99% of the time, is treated as a no capital gain or loss for the purposes of capital gains tax. That means that you can switch your assets between spouses to make sure that from an income tax perspective, it's as efficient as possible. Lastly, ensuring you're using efficiently and effectively all of the tax breaks the government gives you. That means looking at your ISAs, looking at your pensions, and making the most of the tax shelters the government sign off on to give you the opportunity to save tax. As we start to talk about tax efficient wrappers, the ISAs being one, I want to talk about a change in allowances, because from 2027, if you're under 65, the ISA is changing. The ISA allowance is going to remain at 20k. However, once the changes kick in, you'll only be able to use 12,000 of that allowance for a cash ISA, and the remaining needs to be in stocks and shares. Also, as I mentioned before, tax on savings and dividends income is increasing too. So what practical action should you consider taking based on these two changes? The simple one is to look at using your ISA allowances as effectively as you can, as long as they're aligned to your own plan. So I'd consider whether you're using your ISA allowance and your partner's ISA allowance, and are these allowances being used effectively? The other interesting thing for this change for me is that the government are conscious that the majority of new ISA money, about 60%, goes into cash ISAs, when in reality the potential for longer term growth is probably greater over the medium to long term in investment ISAs. So I'd be using this change in the ISA rules as a nudge towards thinking about using your ISA allowance as effectively as possible. And potentially considering whether, even though cash ISAs feel like the safer option, potentially considering investment ISAs, because they will potentially give you longer term inflation beating growth. My fourth point is on state pensions, which continue to benefit from regular and consistent increases in line with the triple lock rules, and are likely, as I mentioned before, over the next couple of years to be greater than your personal tax allowance, the amount you receive as income without any tax at all. There's two actionable points you should consider here. Firstly, if you're not receiving your state pension already, make sure you understand what you're entitled to. Most of us can do this for free online and in about 15 minutes using a link we're going to put in the comments below. And whilst for many of us the state pension won't provide a sufficient income on its own, it is an important consideration as one of the building blocks towards the income you need to live the life you want in the next chapter of your life. So understand whether you've accumulated enough years' worth of national insurance contributions or credits, whether you've got a gap, and what you can do about it is really important. Secondly, look at how frozen allowances and an increase in state pension will impact your total tax bill. There's some planning you can do here, potentially looking at what pots of money are used to generate income every year, and looking at your entire wealth from a helicopter view to extract the income you need in the most efficient way. My next tip is not to forget the implications of last year's budget. The reality is that often we get caught in the noise of the new, and we forget that 2024 had a massive impact on a lot of our plans. I think the big one for me and a lot of my clients in last year's budget was the inclusion of pension pots as part of the inheritance tax calculation as of 2027 when you die. In practical terms, if you die before the new rules take effect, any unused pension pots will pass to your benefits without triggering any sort of inheritance tax calculation. However, from April 2027, this is changing. And if you still have a pension pot at that particular point, that pot will be aggregated with all your other assets for the means of calculating your inheritance tax bill. The practical thing here is how this actually applies to your specific plan. I'm certainly having more conversations with clients since last year about doing more of two things: spending more while you're alive and gifting earlier. Now, both these things need to be considered strategically, because actually spending more and gifting earlier could mean that you run out in your plan, but certainly thinking about the balance of how we use our wealth, provide it to the people we love whilst we're still around, has become more interesting now that pension pots are included in the mix for the purposes of inheritance tax. The reality is that you don't only need a plan to migrate inheritance tax, you need a plan that aligns your own goals, values and focus while you're still around, and considers what happens when you're not. My other big tip here is to plan earlier than you think you need to. My experience working with individuals for 20 years as a chartered financial planner is that people tend to leave their financial planning in any aspect of their lives a little too late. My experience, though, tells me that starting to plan and prepare early, either if it's for the next chapter of your life, typically your retirement, or planning to mitigate IHT, the earlier you do it, the better. My experience is clients have way more success if they start to put their plan and actions in place early. My next point is on salary sacrifice. If you're still working and using salary sacrifice to boost your pension and save national insurance, the 2025 budget introduced a new cap. Now, this actual change doesn't kick in until 2029, but from April 2029, in the 29-30 tax year, there'll be a 2,000 annual cap on earnings you can exchange for pension contributions that benefit from the NI tax relief break. Anything above that 2,000 contributions still benefits from income tax relief, but you won't get any extra national insurance saving. Now, the good news is we've got a bit of time to plan on this one, so there's no need to panic. However, if you're like a decent number of our clients who use salary sacrifice as a compelling strategy, it might be worth questioning the contributions we make and whether we need to make the most of the current rules whilst they're still around. If you're employed and you don't use salary sacrifice, this might be a really useful nudge to consider it, because the reality is I've got clients who are making the most of salary sacrifice because the tax advantages make it a massive potential opportunity for you to build wealth within pensions. My last tip is about perspective. No single budget will change your financial plan for the next 30 years of your life. The reality is budgets come and go, chancellors get replaced, and rules around tax and tax shelters will continuously be tweaked. What really matters is your time and how you choose to spend it, your direction of travel, both in your financial but also your life plan, and how you're gradually adjusting and improving your plan to get closer to the life you want to live. So use this budget to review your plan, then make a few tailored and considered adjustments. Then get back to focus on the stuff that really matters. Your health, your relationships, your community, doing stuff that gives you purpose, shaping the next chapter of your life you want. So there's two other videos I think will be really important for you if you're thinking about that next chapter to help you. In this video, I talk about how Stoic philosophy can help us filter out the noise, reduce anxiety, and make clearer directions into the life we want to live in our next chapter. And in this video, I talk about the psychological side of retirement and why a lot of people struggle when the routine of work quickly disappears. Hopefully that's useful, and we'll see you on the channel soon.